today's recording, we are very fortunate to have Max Bailey with us today, who is the owner of Call the Underwriter. We utilize Call the Underwriter to make sure that we are Dodd-Frank compliant with all of the seller finance notes that we create. And we've asked for him to come on today. I feel like there are a number of people out there that may be doing some seller financing and do not realize necessarily that may be in violation of some of the Dodd-Frank rules and regulations just because they're not aware of it. So I've asked Max to come on board to share the do's and the don'ts, all right, where certain things that you are doing that is subject to Dodd-Frank, and then also we're going to play out some different scenarios and then figure out, okay, is this a subject to Dodd-Frank or is it not subject to Dodd-Frank? So that's kind of the plan for the day. So with that, I am exceedingly grateful and thankful, Max, for you taking time out of your busy schedule to be able to be with us here today and to share your knowledge. And I thank you so greatly also from our personal standpoint of underwriting any of the seller finance notes that we send to you to make sure that we're Dodd-Frank compliant. So I appreciate that all the way around, keeping us compliant. So,
Great.
all right.
Well, thank you, Jay. I'm happy to be here.
All right. Thank you. We'll go ahead and get started right now. First of all, what is this Dodd-Frank that everyone talks about, and what was the purpose of it? What, the legislature of it? How has it all come about?
Yeah, thanks, Jay. Well, Dodd-Frank came about in 2010. It is a result of the housing bubble burst of 07 and 08. Prior to 07 and 08, there was a lot of predatory lending going on. And we're talking primarily in conventional lending, right? Freddie and Fannie. Everything I'm going to tell you affects us in seller finance as well. But Dodd-Frank was written because of the disaster created by predatory lending within the conventional lending for owner-occupied homes. When we talk about owner-occupied, we're talking about anything that is 1 to 4 family that is occupied by the owner. So even if you live in a fourplex that you bought, that's an owner-occupied. And so what happened was for 20 years up into about 06, 07 timeframe, lending really became sort of a free-for-all. LO comp wasn't being followed well. That's loan originator compensation rules. They weren't being followed properly. So people were financially motivated to sell loans at all costs. You may have remembered or heard about teaser rate loans. Teaser rate loans were one good example of risky features in predatory lending, whereby to entice a borrower, they would give you an initial rate maybe as low as 1.25%. And they'd issue you a 30-year loan. And in the fine print somewhere, it would tell you that in the 24th month, this rate is subject to jump by upwards of 5%, 8%. And so what was happening in the teaser rate loans is people were compelled to get mortgages for properties that far exceeded their debt to income ratio at what would be the permanent interest rate. So let's say somebody buying a $400,000 property and they were going to have a $4,700 a month mortgage, but during the teaser rate period, this mortgage was only $1,200, and so it looked great. People were going out and getting these loans right and left. There was big kickbacks being paid. There was major profiteering going on, and out of sight, out of mind, right? Once they issued this loan and the borrower went down the road, all of the lenders and brokers all got enriched. And 24 to 36 months later, when this thing blew up in the face of the borrowers and they went into default, these lenders were long gone, and that was being allowed. And so bottom line is, to make a long story short, Dodd-Frank, Senators Chris Dodd and Barney Frank got together in about 08 and 09 and sponsored this Dodd-Frank legislation, which became law in 2010. Now, there's been multiple iterations subsequent to that, 2014 and even in 2018, some changes, but the actual bulk of the piece of legislation of Dodd-Frank was enacted into law in 2010. And the purpose of Dodd-Frank, and this is what's really important for everybody in seller finance to remember, is the intent. So rather than getting tangled in the weeds and lost in all the little tiny nuances and details of Dodd-Frank, I encourage everybody to keep their eye on the intent. And if we always try to follow the intent, more times than not, we're going to find out we're good to go. And so what I mean by that is the intent, the spirit of the law is to ensure that we're not putting risky features into owner-occupied loans, and that we are always putting our primary emphasis on ensuring that our borrower can truly afford and pay for this loan once we put them in it. And so everything that applies to us in Dodd-Frank, if you always think about all these rules in the context of that spirit, right, of is what we're doing going to be good for the borrower, or is it going to be harmful for the borrower? Most of the time, then what we do, if it's governed with that intent, we don't have to worry so much about all the little tiny P's and Q's. So essentially what Dodd-Frank did, the big thing that affects us in seller finance, two big things affect us in seller finance. Number one was ATR, that's ability to repay. They put upon any loan originator and any lender of an owner-occupied property, 1 to 4 family, they put upon them the obligation to ensure that their borrower meets ability to repay standards. And ability to repay is 8 criteria that Dodd-Frank got together with the lending institution when they were busy spanking the Fannie and Freddie lenders. Then they brought them on board and essentially said, you're going to help us create a fix to what you've done. And so they issued 8 criteria that they determined if lenders always ensured and certified that their borrowers met these 8 general criteria, we'd be far less likely to have people in mortgages that default, a year or 2 down the road. And then the other thing that they did is that they took certain pieces that had been allowed in mortgage lending for residences, and they said that if your interest rate is above a certain amount, and if your mortgage doesn't meet QM standards, that's a qualified mortgage, then you also have to extract these certain risky features from your loan. And we can get into some of those in detail. I'll talk about the general QM factors and the general risky features that we're not allowed to do. But so the bottom line is my job is, having read Dodd-Frank from cover to cover many times and continuing to stay up on it, what I do is when you send me a loan submission, I vet your borrower and I vet your note to ensure that it's meeting those Dodd-Frank requirements. So on the note side, I'll cover that first because it's quicker, shorter, and easier. So on the note side, what I'm doing is I'm looking to make sure that those predatory or risky features that aren't allowed aren't in your note. A good example would be you can't have a balloon payment in the first 5 years. You can't have prepayment penalties. If it's an HCM loan, high cost mortgage, which most of ours are, a high cost mortgage is defined as any APR that is 6.5% above the street rate of the day, or the APOR. So let's say you send me a note and your terms are 240 months at 10% interest, and they're going to borrow 200,000 from you. Okay, that 10% interest would make that a high cost mortgage, so that automatically would flag it. And then certain other aspects of that loan I would want to make sure that you're in compliance with, because it's a high cost mortgage. Another example of that would be Dodd-Frank says if you're issuing a high cost mortgage, you're required by law to ensure that your borrower has homeowner education. Typically, that looks like you paying to send them to home buyers counseling. And you'll notice when we issue initial disclosures, one of those 25 pages of disclosures that we issue you is all of the uh, consumer credit counseling areas within so far from the zip code of the property that you're selling them. Um, so to get around them going to that counseling, which you're required as the lender to ensure that you've given them, we send them to an online course that's been allowed to count as their counseling. So any HCM loan, we flag it as HCM. One of the conditions that we require your borrower to do is to go to this website, and them and any co-borrowers take this online home buyers education course and provide us a certificate afterwards proving that they did it. That ensures that you as the LO, the loan originator, um, will have that check, that box checked for, in a high cost mortgage year, requirement to educate your borrower. So, so basically think about Dodd-Frank as two pieces. You've got loan risky feature issues, and then you've got the vetting the borrower issue. So vetting the note side, the risky features, we just talked about those things that I'm going to watch for when you write your note and you send me your terms. I'm going to watch for those things over here to make sure that your note is compliant, that it's legal, that it's not predatory, that it's not going to draw a lot of red flags for predatory type lending. Then the other side of that is your obligation as the loan originator to ensure that your borrower meets ability to repay, ATR. And so that is 8 general credit worthiness criteria that Dodd-Frank says you as the loan originator must be able to prove that you do each and every time you put a borrower into one of your loans. So you're paying me to vet your borrower against those 8 standards and help build you a file that if a default occurs or anything happens in the future and this is challenged, the legitimacy of your lending practices are challenged, we build you a file that will be your defense to say, oh no, our loan didn't have any risky features in it. And our borrower was vetted 6 ways from Sunday according to those 8 credit worthiness criteria. And we have a track record of everybody that was vetted. And we have a ratio of borrowers that weren't selected because they couldn't pass that criteria versus ones that were selected. So we can prove that we don't just issue a loan to every single person that knocks on our door. We've got a list of people that were denied loans based on no credit worthiness. And the loans that we did do, we've got a sound file built that will show all of those intimate details on how we vetted our borrower and assured ability to repay. So that is Dodd-Frank in a nutshell, the big general piece. And then we can get into, if you're interested in it, talking about those various scenarios of if I'm doing this, this, and this, would that fall under obligation to comply with Dodd-Frank? And if we're doing this, this, and this, would this be exempt from Dodd-Frank? And we can talk about that if you'd like.
Yeah, we're going to get into a few examples of that a little bit later down the road. Thank you, Max. There are a couple things that I think everyone needs to make sure they're aware of and they understand. And please correct me if I'm wrong, Max, on this. All right, you are not the originator, okay? We, as whoever is submitting the information to you, you are just verifying that the borrower or the potential borrower is meeting the Dodd-Frank requirements. The ultimate responsibility, whether or lies with me as submitting that information. I am the loan originator. So just because they meet the ATR requirements or Dodd-Frank requirements does not necessarily mean they're going to be approved for the loan. All right, because that comes back to you. But from our standpoint, we have a few other things that we want to see as well. we're not going to send you someone and waste your time unless we think they're going to qualify. To be quite honest, we do some preliminary stuff on our own, and you're vetting them out and making sure we've got all the I's dotted and the T's crossed, and making sure that you're that you're protecting our backside is essentially what you're doing.
Yes, yep, absolutely. Yeah, and that's an excellent point, Jay. The loan originator, the definition of a loan originator in Dodd-Frank and CFPB, who's the teeth in Dodd-Frank, that's the regulatory arm. Their definition of loan originator is the person that solicits the buyer, that loans the money, and most importantly, that negotiates the terms of the deal. That individual is by definition the loan originator, and there's no way to push that liability or transfer that liability off on anybody else. And also important to know that when we approve a borrower for you and we issue the initial disclosures, that 25 pages of all the federally required disclosures, it lists you as the loan originator right in that package. And so, yeah, it's very important that we make sure that's clear, that by hiring me, you don't get out of being the loan originator. You still always the loan originator. And I've had a few people tell me, well, we're going to use you, but if you don't approve this borrower, we're going to loan to him anyway, because, you know, we believe in him and we want to. And I always try to make sure I let them know, you know, you're free to do that. You can do that. But please understand, I'm going to have a file here that I retain for 5 years, just like the file you're required by law to retain for 5 years. And it's going to say right in there that this borrower did not meet Dodd-Frank requirements, and I'm required by law to save this, and I will be saving it. And so it's not a threat, but it's just important to know that if you hire me to vet your borrower, that's what I'm going to do because I work for you. But if the borrower doesn't make it, I can't with a good conscience pretend he makes it when he doesn't. And so I'll have a retention file here that says he didn't make it, and it'll say specifically where, how, and why he didn't make it. If you then go loan to him anyway, just understand that you will have a non-compliant note. And worse yet, if you're tied to me, I'll even have proof in my file, unfortunately, that you paid me to vet the borrower, and I told you the borrower did not make it. So that's very important to know.
It's one thing that's really nice that you provide is when they do meet that compliance, that they do meet the ATR and the compliance, that they receive a certificate, and we receive a copy of that says this loan is Dodd-Frank compliant. And man, that is golden, because doing the underwriting, and if you're looking to sell your note down the road, all right, the fact that the note was originated, all right, and underwritten by an RMLO, okay, and then you place it with the servicing company, the value of that note is much higher on the secondary market when it comes time to say when you want to sell that note. So it really does behoove you to make sure that you are getting this done. Now I'm going to shift gears. I'm going to shift gears for a second and ask, you know, what's if you don't comply with Dodd-Frank, as you say, and you're just out here willy-nilly, you know, putting anybody into these notes and not doing the underwriting, what's the potential penalties for this?
Yeah, great, excellent question, Jay. Yeah, hang on to your chair because this is ugly. They're huge. They're bad. The CFPB is the one that is the regulatory body for Dodd-Frank. CFPB is the Consumer Financial Protection Bureau. The CFPB is empowered to come after violations of Dodd-Frank, and their standard verbiage is that they charge or can charge $25,000 per violation. We're not talking $25,000 per non-compliant loan. We're talking $25,000 per violation. One note could have multiple violations if you weren't using us. You could have risky features in your note that aren't allowed. Each of those is a violation. You could have a borrower that doesn't meet the 8 creditworthiness criteria. Your failure to ensure that on each of those points could be a violation. Another penalty could be that they could award the asset to the borrower. So you could actually lose the asset. Let's say your borrower went into default and you're trying to kick them out of there, and they talk to somebody who talks to somebody who talks to somebody, and they say, oh man, you guys should go get an attorney and see about this. This doesn't look very fair. You guys are being screwed. And in the process of doing that, let's say they decide to look into, well, their attorney now says, well, then we're going to summons the note and the research file, and we're going to vet that to see if it's legitimate. So they start looking through that thing, and every real estate attorney at this point understands Dodd-Frank fairly well. So it wouldn't take them any length of time at all to look through your packet and say, this borrower obviously doesn't meet DTI. He obviously doesn't meet this state's residual income requirement. And therefore he does not meet ability to repay, yet they loaned him money anyway. So they could potentially say, not only are you not going to terminate this guy and foreclose on him, we're actually going to award the property to him. You're done. You're no longer the note holder. They get this property free and clear, and we're going to issue fines. So it's a really big deal. Really, really big deal.
It's not something that you want to mess around with, because the CFPB certainly has some strong arms and a lot of power. All right, and then
Yes.
it opens the door up to anything that you have done in the past. You're going to be at scrutiny then. So
Yeah.
it is a game not worth playing
Yep.
by any means.
Now, Jay, before half your people hang up and walk away,
We just scared everybody to death.
I should elaborate a little bit, like I try to do with people all the time. I'm going to circle back around again to this idea of follow the spirit of the law. Don't focus on the letter of the law, because I've had a lot of people say, so you're telling me then if we make one little mistake in all of this doing this, they can come back and take all of our assets, they can shut our business down, they can fine us hundreds of thousands of dollars. This business isn't worth it. And every time I try to come back to them and say, you have to look at it the way you look at everything else in life, just like paying your taxes in the IRS, right? It's an attitude issue. If we build a business model that is transparently obvious, that we honor the law, we honor Dodd-Frank, we attempt with everything we do to keep compliance with Dodd-Frank. If somewhere in doing 25 notes, you have some sort of a boo-boo where there's something that isn't completely compliant, I have yet to ever see them throw the book at anybody and lock them up in debtor's prison for a minor unintentional infraction, just like a mistake on your taxes. The people that they're hammering are those people that they say they flagrantly refuse to follow Dodd-Frank. They didn't underwrite their files. They have predatory features in their lending, and they did it time after time after time after time. And oh, by the way, they have foreclosed on numerous borrowers, leaving a trail of injured victims in their wake. That's the guy that they're going to come after and skin him alive. So again, I guess the attitude that I want everybody to try to remember and focus on, and my business is built on this model, so we always do it, is everything we do is about trying to transparently follow the spirit and the intent of Dodd-Frank, not to injure owner-occupied families and borrowers. One of the evidences they say in Dodd-Frank that they look for during violations, one of the evidences is that you followed an underwriting method that results in historically low default rates. That's the exact verbiage, and they use it over and over and over again. You use underwriting methods that result in historically low default rates. And that's very important to remember, because it's a long track record of what we're doing that is going to either speak for or against us, right? And by us, I mean you. And so again, if the flavor of your business says that this guy created 50 notes, all 50 of these notes were professionally underwritten, they have a record of all the borrowers that they had to turn down because they didn't meet it. That shows that they're not just taking any borrower that they can. And oh, by the way, They don't have any notes that have defaulted. They haven't had to kick anybody out of a house. So they've actually done no harm to anyone. That's what we're trying to build. If you do have a default, let's say you do 20 notes and you do end up having a default, well, then what we would want to do when you have that default is you'd want to build a good record that shows why that default existed. It wasn't because your borrower wasn't vetted properly. It wasn't because your borrower didn't meet residual income, didn't meet debt to income ratio. Instead, it was because 2 years into the deal, he lost his job, or he got a divorce and half of his income walked away. Now we couldn't help him anymore. He couldn't make this happen and he defaulted. Well, then that default isn't even going to be a result of inability to repay because of something you did. And so then you would document that properly. You'd obviously go to great lengths to show that you worked with this borrower to the greatest extent possible. By the time you finally defaulted on this borrower, you've lined up all your P's and Q's, you got all your ducks in a row, and you've created a retention file to CYOA for why you had to default, you had to foreclose on that guy. If we're living like that and not like playing the Wild West, and being a charlatan and leaving a string of injured borrowers in our wake, we probably shouldn't have a lot to worry about.
Okay, great, thank you. Let's go, we're gonna adjust one thing here. Let's just not get too far down into the weeds, because I know this could take the rest of the night and we don't want to do that. Okay, but let's just touch real quickly. I'll say your 8 key points, just highlight what they are, and then we'll get into some scenarios that we're going to go through.
Excellent, you bet. Okay. And before I go into these, I want to let you all know that I have coaching material on all of this stuff I'm going to talk about. And I highly encourage you, if you're going to bring files to us, to ask for my new investors packet, read it from cover to cover, because a lot of what we're going to talk about here on these requirements in Dodd-Frank, you can pre-screen your borrowers. You should pre-screen your borrowers before you ever commit them to an application, receive earnest money, and send a file to us. And half the people that aren't going to make it, you'll already know and have already turned them down before you ever get to the point of putting a package together and sending it to me. So they are 2-year work history, 2-year income history. That's required in Dodd-Frank. Obviously, debt to income ratio. Now we're far more flexible than Fannie and Freddie. That would typically look like front end of 29 and back end of 36 to 43. We don't do front end and back end. All we do is a straight DTI. So it's your total debt and it's under 57. So it's very flexible. A lot of people we can get to qualify that a bank would just shut the door in their face. They need to be able to make residual income. Residual income is a state-specific figure based on the taxes in that state, their state income tax, and their income and other expenses that they have. So every single file we run also has to pass your state-specific residual income. That's a big one. One of the big things, just as a side note, when you're considering borrowers who have lots and lots of dependents, even if they meet DTI, understand going into it that that's going to make it far less likely that they're going to meet residual income. So just beware when you're sending us a file that they have 6 dependents. They're going to need to clear the DTI by a long ways. For instance, if you have a borrower that has no dependents and let's say that we get them down to a DTI of 56, they just squeak under that 57 DTI. More times than not, they'll make residual income because they have no dependents. Because residual income is a factor of what it costs to feed your family every month. So just know that when you send me a file and they've got 3 or more dependents, and you take their gross income that you think they're going to have and you multiply it by 0.57 and you figure out what their DTI can be. If they've got lots of dependents, if they come in around 50 to 56, those dependents are probably going to mean they're not going to make residual income. So those borrowers, you want them to be down in the 40s at the tops on your DTI. And then credit worthiness. This is one of the big ones that really kicks us in the guts. Credit worthiness. So Again, we're very flexible compared to Fannie and Freddie. Fannie and Freddie define credit worthiness as an arbitrary number, right? If you don't have a credit score of at least 620 and 2 lines of open credit that have been 6 months or more with no late payments, boom, we shut the door in your face and send you down the road. That's credit worthiness. We don't do that. But we still have to assure credit worthiness. And so one of the ways we do that is if they have a credit score under 620, then we help them build alternative credit. So the under 620 tells the world that their traditional credit is subpar, no doubt about it. So under 620, then we make them go get out a 12-month BOR, get a verification of rent from a landlord stating that they have made their rent payment for the last 12 months with no late payments. So when you're pre-screening your borrowers, this is a perfect example of how you can get ahead of the curve. One of the questions you'll want to ask your borrowers is, do you know your credit score? Have you been turned down by a bank for a loan? And is your credit score likely going to be under 620? Most of our people are. When they tell you yes, probably, then right there, you want to be able to ask them, okay, would you be able to provide a 12-month letter from your current landlord stating that you haven't made a late payment in the last 12 months? When they give you that sheepish deer in the headlights look and basically beat around the bush to finally come clean and tell you no, they probably can't do that, dismiss them politely and tell them when they can do that, come back and see you, because that borrower is not going to fly. Now, I'll caveat on that and say, if you're trying to build a crop of next year's and the year after's borrowers and you're renting to them now, then that's an awesome time to tell them, if you stick with me, I'll show you the things that you need to do in the next 12 months to turn you into a borrower if you're not today. And one of them will be make 12 good rent payments in the next year. Do not be late on your rent. Next year, we'll be able to provide that BOR for you, and we'll be able to cover you on your rent because you've rented from us for 12 months. Another aspect of credit worthiness is 24 months of provable good payment history. So you want to ask them, do you have any open lines of credit? When we pull your credit, and we're going to, so that way they're not compelled to fudge, or tell you mistruths, let them know we will be pulling your credit. So when we pull your credit, do you have any open lines of credit? Do you have car payments that are reporting to credit? Do you have credit cards? Do you have any open lines? That's very important, because the ones that tell you no, we don't have any open lines of credit, again, Fannie and Freddie would shut the door and kick them out down the road. We can work with them, but the question you want to ask them then is, using our alternative credit list, which I will give you, you hand that to the borrower right then, and you say, will you be prepared to provide 2 12-month histories, payment histories, from something on this alternative credit list that would vouch for your good credit? That might be like your car insurance, your cell phone, utilities, your Netflix account, anything that doesn't report to credit that you're making a good payment every month on. Will you be able to bring me 2 of those 12-month histories? When you get that guy that says, no, my car is in somebody else's name, my cell phone is in somebody else's name, I don't pay utilities, and I spliced my cable together and I watch Hulu for free from my neighbor. Again, pat him on the back and
Yeah.
invite him to rent from you, and tell him you can help him clean that up in the next year to 2 years. But today he will not be a borrower, because as soon as you send that file to me and I pull his credit and there's 0 open lines, the first condition I'm going to hand back is, in order to approve his loan, we need 2 12-month histories. You can already know ahead of time this borrower is not going to be able to do that. Very important.
Yeah. I hate to say it, but he probably wouldn't be running from us either.
And he may not be. He may not be. But for those of you, and I encourage this, because I believe not only do we not want to do no harm to borrowers, we also want to be able to advertise to CFPB and Dodd-Frank that our business model is actually helping borrowers.
Right.
So we take borrowers that are asking us for a loan, we pre-screen them, and when we find borrowers that aren't credit worthy today, we don't give them the boot and kick them to the curb. we invite them to rent our properties on a lease option, and we coach them through credit repair for the next 24 to 48 months. If you do this, this, and this, and every month you bring me a record that you did it, and I help you build that record, you can own this property you're renting from me in 24 to 48 months. So think about what a defense that would be to CFPB and Dodd-Frank if not only are you properly vetting your borrowers and you're adhering to Dodd-Frank regulations and all that, but on top of that, you're actually grooming a group of people who wants to and aspires to be homeowners. And when they're not capable of being a homeowner, you're now renting to them, and you're essentially coaching them on how to build credit worthiness so that they will be Dodd-Frank compliant in the future. That's where we want to be as a seller community.
All right. All right. Super. I don't know what number that was.
Well, I'll just rattle them off real quick. So
Okay.
the criteria are credit worthiness, right? That would be that at least 2 open lines of credit for 12 months each, and a verification of rent if your number is under 620. That's credit worthiness. 2-year work history, 2-year job history, meeting your state's residual income, meeting ATR, the ability to repay as defined by debt to income ratio. And then the other one is no current bankruptcies, no current forbearances, no current foreclosures, and no delinquents in credit. So when we pull your credit, and this is another one to explain and ask your borrowers when you're in your pre-screening, when they pull your credit, are we going to find any open collection accounts that you still owe on that they're coming after you? And are we going to find any open lines of credit that are currently delinquent? If they tell you yes, you don't have to dismiss them politely, but then you have to ask them, will you be prepared? Will you be capable of paying them off in full before closing and providing a letter proving that they're paid in full or that they're brought current? That will be a condition. If you can't do that, let's say you've got that guy that says, I just did one this morning, they had 11 lines of credit that were all in collections open. One was 6,500, one was 4,800, one was 257, one was 862. They had 11 of those. They cannot close a loan until every one of those is either paid in full or they submit an approved payment plan to us. So when you get that guy that says, yeah, I got a couple that are currently in collections, that's okay. But will you be able to satisfy that before we close the loan? If you can, no problem. We can probably work with you. If they say, yeah, no, probably not. I owe 6,500 and I don't plan to pay that off. All right, well, thank you very much. Send your friends to us, but go away because that person will never make it.
Yeah.
So those are the 8 things, the 8 general criteria that Dodd-Frank would look at you as a lender and say, why were you not checking all those areas and ensuring that all those areas met compliance? And that's a big laundry list, and there's a lot of things to check and a lot of areas to check. That is what we're doing when we vet a borrower for you.
And Max, the one thing that I want to bring up here is the fact, this seems like a lot of things the hurdles that have to be overcome, all right, when you're working with people.
Yes.
But what I would essentially say is this: the purpose, one of the primary purposes that you're doing seller financing is to create an opportunity for someone to own a home, and also creating a note, all right, or a contract, land contract, that's going to perform for the long term. I mean, many of us who have had rentals know the most expensive part of having rentals is the turnover. So if you're doing this work up front, the greater likelihood that your candidate is going to perform down the road, and that you're going to have a good loan or a good contract, and it's performed for the next 20, 30, whatever years, it goes tremendously in your favor. And our experience to date is we will not work with anyone unless they pay at least 10. They're able to pay 10% down of the purchase price of the home. One of the reasons we do that is because if they are able to pay at least 10% down, they've shown some discipline right from the get-go that they can manage their money. if you're working with someone that's going to only put $1,000 down or 1,500 or $2,000, they're a renter. Okay, they are not a homeowner. We are looking for people who are making that transition from the rental aspect to be able to learn to be a homeowner. And if you've got enough self-discipline and wherewithal and management to be able to save up to have that 10%, then you've shown us enough discipline that we can work with you. And that has borne out very well for us to date.
Yes, Jay, one thing there too, to caveat right on that, is the other issue about that, observing that LTV is a skin in the game factor.
Right.
People are less likely to default when they've got skin in the game. Renters don't have any. So it's no big deal for a renter to, break the lease, break the contract, trash the property. When you put a borrower in who saved for 2 years and he's put that much profit in there, they're way less likely to just decide, well, I'm going to skip a mortgage payment because it's convenient. And hey, I can just always skip down the road if this doesn't work out. No, because they've got 10 grand on the table.
Right. Exactly. Right. And it really does work. So, all right, we're going to move on here. We're going to kind of cover some scenarios here. And Max, so what we're going to ask for you to do is in each situation, tell us whether this situation would be subject to Dodd-Frank, okay, to the rules. First of all, I think it's important that everyone understands when we're talking, and correct me if I'm wrong, but pretty much any type of terms that you're selling a home to an owner occupant pretty much falls underneath Dodd-Frank, whether it be a land contract, note and mortgage, contract for deed, note and deed of trust.
Yep.
All those terms, all right, those are different. We're in a land contract area here in the Midwest, all right,
Yep.
A note and mortgage. Other parts of the country is called a deed of trust, contract for deed.
Yep. You can't give it a fancy name and get out from under Dodd-Frank. No matter what you call it, if you're negotiating the terms and you're loaning him money at interest for his owner-occupied home, you are under Dodd-Frank. Exactly.
Yep. Next one, mom and pop selling a current residence that they own, they've lived in, and now they're selling it to another owner occupant. This is their only transaction. Is that underneath Dodd-Frank?
They are going to sell and finance?
They are selling their home via contract. We'll say land contract in this. Their personal residence. They're not an investor. They're not an investor. They're just mom and pop selling their own home via contract to someone else.
Doing this one time.
One time.
They are not under Dodd-Frank. Yep, they're okay.
Okay, they're okay.
Yep.
An individual who has inherited a property through an estate, all right, and now they're selling it on terms to an owner occupant. Again,
yep.
They're not doing this as a living or investing on the side or anything. They just inherited. Are they subject to Dodd-Frank?
Nope. If they don't bring anybody else in on the deal, they're not subject to Dodd-Frank.
Okay.
Yep.
All right. Investor buying a property subject to the underlying mortgage and then selling it on terms via a land contract to an owner occupant.
Yep. Under Dodd-Frank.
Under Dodd-Frank. Absolutely. Yep. And an investor buying a property in cash, refinancing it with a private lender or a private investor or with a bank, and then selling the property on terms via either a wrap mortgage or a land contract to an owner occupant.
Yep, under Dodd-Frank.
Yep. A part-time investor that has a full-time job and invests on the side, selling 1 to 3 properties a year on terms to owner occupants.
Under Dodd-Frank.
Absolutely. An investor selling a rental home on terms to another investor.
Is it owner occupied?
In this case, it's not owner occupied, it's a rental.
Okay. If it specifies that the purchaser is not owner occupied, it doesn't fall under Dodd-Frank.
Correct. Okay. That's my understanding is I want to make sure I'm understanding these too.
Yep.
So.
Now, just so you know, we do a lot of these. I have a lot of investors that are about half and half with owner occupied and not owner occupied. And they have all found this service to be so valuable in terms of preventing them from having a defaulted note or helping them resell that note later. I have lots of investors that tell me all the time, this one's not owner occupied, but we don't care. We still want you to do your normal underwrite. So that's how valuable they feel this underwrite process is.
Yeah, and I would agree. You're not subject to Dodd-Frank, but to protect you, to make sure that the loan's going to perform and the borrower is going to perform, it's a wise investment. And let's keep in mind here, we're not the ones paying for your services. We are actually making the borrower pay that. We call it as an application fee, but that money, comes to us to pay you for doing that underwriting. So we basically
do. And in lending law, that's a bona fide expense that can be passed on to the borrower. In other words, that's not a fluff. And so because of that, yep, you can wrap it right into the loan, call it part of the loan origination, and we can talk about what loan origination caps and fees points are in Dodd-Frank as well, but that can be wrapped into loan origination fees.
Okay. All right. A full-time real estate investor selling 1 to 5 properties per year on terms to owner occupants.
Under Dodd-Frank.
That was a softball.
Yeah. Yep.
Here's one I don't know on. Okay, a note investor purchasing a land contract that was not underwritten by an RMLO, but wishes to convert the land contract to a note and mortgage. Do we have to underwrite them at that point and make them subject to?
Is he getting any new money from the borrower? Is he changing terms at all? Is he charging any kind of a loan origination transaction fee for what he's doing? If so, it has to be professionally underwritten, and the buyer has to meet ability to repay again. Here's the issue with that one.
Okay.
If the same borrower is already in the property, Dodd-Frank doesn't expect us to now kick them out because when we underwrote it, they don't meet it if they never were required to meet it. Okay. But the person doing this is under obligation if they're negotiating any new terms, changing anything with that borrower, or recreating a new loan, then yes.
Okay. All right. So if you're keeping everything the same and just changing the land contract over to a note and mortgage so that the borrower can actually have the deed to the property rather in your name, it's not subject to Dodd-Frank then.
Yep. Okay. And now, just so you know too, I do have some investors that have approached me. One gentleman has almost 100 notes. He had never followed Dodd-Frank, and it's come to his attention that he should, and so he's nervous. And he's now asked us to gradually go through all 100 of his and underwrite them all, and with the understanding that he can't kick these people out if they don't make it. But he's concerned enough that his view is, I want to at least have it on record that when it came to my attention, when I gained knowledge of my requirement to be Dodd-Frank compliant, I attempted to go through my entire portfolio and underwrite everything per Dodd-Frank and make as many notes compliant as possible.
Right.
So just something to think about, the way other people are thinking about this.
Sure. Well, and the other thing is, in this type of situation, if we're looking to purchase a contract for deed or say a note and mortgage that was not underwritten by an RMLO, all right, now the contract for deed, we may look at trying to change that over to a note and mortgage, but it's already performing. It already has some seasoning, because we're not buying that type of note. Just in our underwriting and how we evaluate our purchases, we're not going to buy that from the table not being underwritten by an RMLO. It's going to have 2 or 3 years seasoning underneath of it before we're going to buy it.
Yep. Yeah. So, and I've talked to an investor too, whose view is too, if I'm considering to buy a note that was never done this way, I'll make that a contingency that they send it to you and that we get it underwritten before I take the note.
Okay.
So, yep.
All right. What suggestions do you have to help investors guide their potential clients towards Dodd-Frank? And I will preface this by saying that you have a plethora of information, all right, on your website. Okay, and we're going to put that website up at the end. You have it is all at your fingertips, guys. Okay, it really is. I think I have downloaded every PDF that you have on that website, and I've reviewed it. So
yeah, awesome.
There's a lot of great information on this website. So just give a couple highlights here.
Yep, absolutely. Okay, so suggestions to help your investors move toward compliance. So let's say I'm going to talk to those of you who are renting to people that you're wanting to turn in from renters, you're wanting to turn them into your buyers. Again, it's going to be that any open lines of credit they have, they've got to be current on them. They've got to currently be paying all their current obligations. If they've got low credit scores, they've got to be paying good enough rent to be able to get a 12-month BOR. If they have no open lines, then they've got to be paying other things in their name that they can bring to the table and say, here's my cell phone bill for a year, here's my utilities for a year, here's my car payments or my car insurance for a year. 2-year work history, 2-year job history, and this is just critical. If you're dealing with job hoppers and they're not in the same industry, so a guy worked at Walmart last year and now he's at a tire shop, and the year before that he was a landscaper, not going to work. So you're looking for borrowers that have been in the same line of work for 24 months, and they need to have 24 months of consistent earning. That's big.
What about the self-employed individual? How do you go about documenting that further?
Yep, self-employed, I love them. I do them all the time. Self-employed is really easy. They can prove self-employment one of two ways: either last year's tax return, or better yet, 2 years tax returns, but bare minimum last year's tax return in that business and still be doing the business now, or 12 months of current business bank deposits. And I hesitate to say this out loud because I shouldn't probably be the one advertising this, but I'm going to tell you all, when you're talking to your self-employed borrowers, don't send me tax returns and bank deposits, because I'm obligated by law to use the lowest of those two. Ideally, what do we all do in business? Everybody tries to show the IRS they're making next to nothing, right? So that's going to show when they turn in their taxes. You as a lender, what would you prefer that a self-employed person turn into me? 12 business bank deposits, because that's going to look far more favorable. I divide that by 12 and then subtract 25% for overhead, and that monthly average is their gross. Almost no one has tax returns that are going to show that same amount of income if they own a business. So when you're talking self-employed, if they can turn in 12 current business bank deposits showing all that money, that's going to fare better for their DTI than last year's tax return.
Okay, that's 12 months. That's 12 months of bank. You
12
said,
months.
Yeah, 12 months. So
yeah,
that's
now,
a pearl. That's a
ones,
pearl. That's a pearl.
It is a pearl. I do get people that only turn in 8, only turn in 9, but they're making 600,000. So I still divide it by 9 and they come out fine. So it doesn't have to be 12. 12 is ideal, obviously. That's the gold standard, but we qualify people on less.
Okay. And for some, obviously for some self-employed individuals who are seasonal in their business and what they do, you smooth that data out so that it,
Yep.
so that's the good point with
Yes.
all of that. So
yeah. Now we could do another 8-hour clinic on qualifying income. I am serious. This is the hardest part of the whole job.
I know.
We could talk for 8 hours straight, and I could give you all a yellow legal pad and 5 pencils, and at the end of this, you'd have them all broken and you'd be out of paper and still not exhaust all of the challenges with qualifying income. So just understand that qualifying income is huge, but I'll rattle off a few things to you. We can't count income from jobs they don't currently do. We can't count income from second jobs that have been held less than 2 years. We can't count unemployment if they're not going back to that same job. We can't count unemployment if they've been fired from that job. I mean, when you talk about qualifying your people's income, there are so many things to know. I couldn't possibly give them all to you, but I try to give you enough basics that when you guys are, if you'll use my FAQs that are on my website, some of those are talking about qualifying income. When you ask your borrowers questions about income, the big things have to be like this. A, are you working right now? When the answer to that is no, pat them on the back and show them the exit, give them a glass of water on their way and say, thanks for your time. If they're not currently working, don't count it. Money in the bank doesn't work. So it doesn't matter if they say, well, we've got 30,000 in the bank. Doesn't matter. It's income. So now that's a positive that I'll want to note in my underwriting notes for you that goes toward credit worthiness, that, hey, they have cash reserves of 30,000. That's a strong positive, absolutely. But that won't qualify income. What is their current income? If they don't have any, then we can't qualify them. If we need a 3-year continuance, this is lending law, by the way, folks. Anybody that doesn't know, this is lending law. So this applies to Fannie and Freddie as well. This is just lending law. All forms of income must have a 3-year continuance. So if they tell you, I get $1,700 a month in child support, your first question should be, how old is the child, and can you prove that they'll get it for 3 more years? Also, is a court-ordered child support, or is it just your ex's generosity and word of mouth, that him saying that he'll always give it to you? That won't work. If that's the case, then minimum you need to show 24 months of bank deposits in your bank proving that he's paid it every single month for 2 years, and then that the child's birth date won't put them past 18 for at least 3 years. So all income that your borrowers tell you they want to use, it has to have a 3-year continuance on it. Let me think what else.
I know.
Oh, here's a good one. ITINs and SSNs. A lot of you work in demographics with folks that don't have ITINs or SSNs. Walk away. They must have one or the other. People who work for cash only and can't prove where they get it from. It's probably from the cartels. So nope. Well, double bolt your door when you pat them on the back and send them out and hope you have bulletproof glass, but you can't take their income if they can't prove it. So if they say that they're self-employed, they've got to be able to prove it. W-2s and wage earners, they need last year's W-2, and they need their 2 most current pay stubs. And we use three calculations on them. And then lending law says we use the most conservative of those 3. So I get chewed out a lot by people for doing this. They send in their W-2 worker, and they send in last year's W-2, and they send in 2 current pay stubs. So last year's W-2, divide block 5 by 12, and that's the average. Then I take their pay stub, and we take their year-to-date figure, and we multiply that, or we divide that by the fraction of the year that they worked for, and we use that average. And then we take their hourly rate, 16 an hour times 40 hours times 52 weeks, divide by 12, and that's an average. We have to use the lowest of those 3 averages. So they're notorious for having a W-2 where they get a lot of overtime and bonuses. So their block 5 in their W-2, let's say, supports a monthly payment of $2,800. But their current pay stub, we don't use overtime or bonuses unless they can prove that it's a permanent part of their income. So that makes that figure lower. So when I tell them, this is what I qualified you at, and here's why, they throw a fit and say, it was on my W-2. You can see I got it last year. And I always say, that's wonderful, but be prepared to go back to your employer for a letter stating that overtime or bonuses is a permanent part of your income and expected to remain so. So what do you as the lender do when you're interviewing your borrower about income? You have that discussion with them, and you say, if you get consistent overtime and bonuses, in order for us to count that for your income, you have to be prepared to bring a letter from your employer stating that X amount of overtime is consistent in John Smith's pay and always has been and is expected to remain so. Then I could go to that pay stub and I could add in all that overtime or those bonuses, and that would make that current pay look better, like that W-2 from 2020. We're in 2021. This is killing a lot of people this year, COVID problems. So 2020 W-2 only shows $8,000. Current pay stub shows this guy, he only made $8,000 for the whole year. And the current pay stub shows this guy makes $6,000 per month. Well, if I have to divide 8,000 by 12 from last year, he's going to be down to nothing. So why is that so low? So I go back to him and I say, your 2020 W-2 only shows about 2 months worth of income. What's going on? And then they say, well, I was laid off half the year due to COVID. No problem. bring me a COVID letter from your current employer, the employer that's from that pay stub, from that W-2, and who's still your current employer, and bring a letter that says, John Smith's 2020 earnings were extraordinarily low due to the fact that we laid him off from April through November, and he's now back to making his normal wages and expected to remain so. No problem. Then I can put in the underwriting notes, we discounted the 2020 W-2 due to COVID, and we're crediting him with the income that's consistent with what he currently makes. I do, and this sounds picky as hell, I know it does, and I've had a lot of lenders whine and fuss at me, but I always try to explain to them, you hired me to build a file that's going to defend you. This is how professional underwriting has to be done.
Fantastic. Thank you. What can, I think you've already covered this to a certain degree, this question. How can call the underwriter help investors? Bottom line, it's going to be a better note. Okay. You're going to have a better note, better performance, and it's going to keep you out of trouble. That's the bottom line.
Yep. Bottom line is that. Now, some real specifics to that also are, again, I can help educate your borrowers so that if they're only renters this year and we can't approve them, if you want to keep that renter close in your hip pocket, I can give them the coaching and then pass that on to you so that for the next year, you can groom that borrower. And this time next year, you'll have a solid borrower. So we can do that for you. Here's another thing we can do for you. If you send in a package, let's say, and you send me a borrower and you want to loan him $200,000 at 10% for 180 months. And I come back to you and say, Jay, unfortunately, while your borrower is a good borrower, he won't qualify for this particular deal. What I give you is a range of options. I'll tell you what he does qualify for. I'll tell you what we could do to make him qualify for this. And if he absolutely can't qualify for this, when you're done, what you know now is what he does qualify for. So then you can bring the borrower back to the table and say, listen, unfortunately, guy, I can't put you in this particular property. That's just that's a Cadillac. And right now you're only at Chevy Chevette level. But I happen to have another property and I know that you'll meet DTI at this loan amount and this interest rate for this term. So again, now what this underwrite does for you is you don't lose this borrower if he's still a good borrower. You just help fit him in a better car for him and his family.
That's where he's at. Yeah, that's very helpful. What are some things, when we do submissions, what are some things that we need to do to help make your life simpler on your end?
I'm glad you asked that. Number one, the most important thing by far is when you send a submission to me, you'll notice on my website, there's an Excel spreadsheet that is for putting the terms of the deal in. All of our best investors have gotten trained to the point where when their packages come to us, their packages look the same every time, consistency. So they send us that Excel spreadsheet. That Excel spreadsheet tells me everything about the deal. It tells who you want me to invoice, who the lender is, who the borrower is, all the full names that are going to go on the borrower's application. What is the sales price? What is the loan amount? What is the earnest money? What is the down payment? What is the APR? What is the term? Do you want it escrowed? Do you want just insurance escrowed? Do you want just taxes escrowed? How much insurance is to be escrowed? What is that insurance figure every month? What is that tax figure every month for the property taxes? All the stuff to the deal. If you have that all in there every time, I can fly when I get this. If every time you send a submission, I've got to stop and try to get you on the phone or the email and say, do you know what the property taxes are? We can't find them in Zillow. Do you know what the insurance is? Do you have an estimate? Do you want it escrowed? Who's the title company you want this to go through? It slows the deal down a ton. And so the way you look professional and make this streamlined is you get used to, if you have a transaction manager, send them to me and I'll train them. Every submission, all the terms to the deal get put on that Excel spreadsheet. Then when you send me a submission, it looks like this. You shoot me an email saying, Jay here with a new submission, and I see an Excel spreadsheet. I see a 1003 application with the borrower stuff on it. I see a borrower's authorization signed allowing me to pull their credit, and I see their income documents, that's a complete submission. It should come from you to me with all of that in it every time. Then the first thing I do is pour through it and send you back a needs list. Sometimes I have no needs at all, and I can just say, Jay, that's awesome. We'll get to work on it today. Other times I might say, hey, yeah, I noticed, you got W-2 wage earners, and I see they've got a W-2, but their W-2s from 2019. It's not from 2020. Please ask them for the current one, but we'll get working on it in the meantime. But it allows us to get a real concise read really quickly on what's needed to perform an underwrite and roll with it quick. So you'll be the investor that we don't grimace when we see an email from you, whereas a lot of them we do. And here's another thing that's happening a lot that really eats our lunch. And we're not going to whine about it. We're big boys and girls. We'll keep on marching, but it makes it harder. Is we get emails from borrowers saying, here's my 200 cell phone snapshots of all this stuff that my investor said I'd need to give you. And we get 25 emails from a borrower. I don't even know who the investor is. And there's no terms to the deal. And then we've got to play this game of getting back with the borrower and trying to pour through all this stuff and then say, oh, by the way, who's lending you the money? Who's the investor? We haven't even heard from them yet. So please don't have your borrowers come straight to us. Utilize our website. Look at the 5-step process for creating a submission and build that process. And if you want to call me ahead of time, every time you're putting one together and run the scenario by me on the phone and let us visit for 20 minutes, that's fine, no problem. But yeah, please put all the documents together yourself, send us a submission, and that'll make it way smoother.
We have found it's worked best if everything runs. We just don't allow the borrower to make any contact with you. We are the point of contact, so we are in the middle of the game, knowing what's transferring, what's flow and what you're getting,
Yep.
etc. It has worked. It works much better that way. And I will confidently say, once Max gets all the information, their turnaround time is excellent. All right, it's 24, 48 hours typically, and that's you're very good on the turnaround time. So
no, I will say this: we try to be very flexible. We deal with over 1,000 investors, and we don't do it exactly the same for anybody, because we do try to work individually with you and your business model and your issues. So at the risk of being exploited here, being under recording, I will say, if you ask me to contact the borrower and work this or explain this to them, or I ask you for something and you say, do you mind just asking the borrower for that? I will do that. And we try to do that. But I totally agree with Jay. I much prefer the engaged investor who says, we'll be the point man, we'll be the middleman on this. Some of the bigger people, actually, what they're doing is they actually assign a transaction manager. So the investor I hardly even deal with, but he has this gal that he sends to me. My wife and I coach her. We show her how to use the forms. We build a rapport with her. And then every time a submission comes, we're dealing with the same person every time. And very quickly, it's a seamless operation between us.
So, well, here's the picture of the website, calltheunderwriter.com. There is a tremendous amount of wealth of information that Max, that you have on that website. As I said, I had downloaded, I think, every PDF that you and Excel spreadsheet that you have on there. But if you go to that site and just download the things, review them, they're not hard to read. You will be miles ahead of the individual who is totally uneducated in this area. Max serves to protect your rear. Okay, to be quite honest. All right, you're utilizing that in your fee structure. I charge $500 upfront as an application fee. And how your charges are is, if I remember right, it's $119 for the initial submission. Is that correct? Okay.
Correct. Yep.
Yeah, $119 upfront for the initial submission, and then then when they come back and they become compliant, then you pay them the balance. So it's a $500 fee. 480 or the other 380. Okay, all right.
Yep,
So it's
yep.
like
So 499 total is, so if
499.
you always hold out 500 earnest money from your borrower, then there'll be something there to reimburse yourself for. Or like Jay said, I like your idea. I'm going to share that with more investors. Yep, just charge them again. They've got some skin in the game. Charge them an application fee.
Yeah, we require upfront when they sign the purchase agreement, they're going to pay 500 as an application fee, and then either depending upon the amount of earnest money on the value of the property, we require $500 as earnest money if it's a property valuation of 100,000. If it's over 100,000, we require they pay $1,000, and we put that into escrow with the title company, and we keep the 500 as the application fee, and that is non-refundable. So if they don't qualify or they don't follow through, we keep the 380. Okay, if they don't qualify, we keep the 380 for our wasted time. That's what we basically do.
Yep.
So, Max, thank you so much for spending time, your wealth of information. You help keep us compliant and keep us safe. And I sleep very well at night knowing you are on my team.
Yeah, yeah.